Chris Conway from the Australian Stock Report is joining us live from our Melbourne studio. Chris, good afternoon to you and thank you for joining us. Now, the Trump bump is certainly continuing, US markets rallying to those fresh record highs overnight. Our local session off to a roaring start today. What are you making of the market's reaction?
Good afternoon, Leanne. Well, the animal spirits are alive and well, shall we say. Really a tremendous run in the US over the last month or since Trump was elected as president. I will claim a little bit of vindication here. I have been calling consistently, I hope you'll back me up, I've said this on the show, calling consistently for a big melt up in US markets. I think what we saw overnight was further evidence of it. I'd been calling for a target on the Dow of 21,000. Of course, the US market punched very clearly through that level overnight. And now the question really becomes, is there further upside to go? On the evidence of what we've seen, perhaps there is.
What do you think it is? Because there has been a lack of policy detail. I mean, up until now, we've been waiting on that concrete evidence. I think the market's rallied over 15% since Trump was elected in November. What was it about the speech that's really boosted markets? Is it the fact that, well, maybe not everything is quite adding up right now, but we are clearly heading in the right direction?
Look, I think ultimately Trump's pro-growth policies, whether or not he's able to achieve the lofty target of, I think it's 3.5% growth, similar to what the target is here in Australia. We haven't been able to achieve it over the past few years. But that is a lofty target, and the fact that he's going to try to achieve that he's going to, or he claims to, want to cut taxes and increase infrastructure spending, they're all positives. Now, we need to see where the rubber hits the road on all of this sort of stuff and see whether it's anywhere near achievable. There remain a lot of skeptics. I would probably put my hand up and be one of those people that remain skeptical that he can achieve all of what he wants to or what he claims to be able to. But right now, as I said, it's a bit of animal spirits. I don't think we're at the point yet where it's irrational exuberance, where the market has just run ridiculously far away from itself. But, we're sort of getting into that territory where I think a few people are starting to say, well, hang on a second, why are we up here? 21,000 was the level for me on the Dow. That's the point, I think I said it on the show last week, where I think people would start to really ask the question, well, what are we doing up here? Is it justified? And has the rally that we've left behind, is it sustainable? So I think now is the time to really start asking some questions. But in direct answer to your question, it's the fact that we have a pretty strong US economy. I think what was really telling overnight, what I really enjoyed seeing, just from an analytical perspective, was the fact, as you rightly say, expectations for a rate hike in March have jumped to 65 to 70%, yet the market didn't even blink an eyelid, didn't even bat an eyelid, I should say. It just kept marching higher. So even if the Fed now is going to raise rates and maybe raise rates faster than what people had previously been anticipating, it seemingly doesn't matter. It's the sign of a healthier US economy, and people are willing to bid up stock prices off the back of that.
As you say, getting closer and closer, though, to being priced for perfection. Trump's seeming to be setting the bar pretty high for himself. So, look, we'll obviously see how it all plays out. I think since his inauguration, so about a 5-week period, less than 5 weeks, the market's rallied 1,000 points. I mean, that's pretty significant. The fastest and biggest rally ever, that 1,000-point rally ever. I think when we got to 20,000, we were reluctantly starting to talk about 21,000. Only took a matter of weeks. Do you think 22,000 is the next realistic target?
That's a really difficult question, Leanne, and I honestly haven't lent too much thought to it. You are right in saying that it was 24 days to add 1,000 points from 20 to 21,000. The last time the Dow did that, I think, was in 1999, perhaps, moving from 10,000 to 11,000. Of course, that was a 10% jump, though, in terms of percentage move. 20 to 21,000 and only a 5% jump. Still impressive, but not quite as impressive. Where the next target is, I honestly don't know. Like I said, I haven't lent too much thought to it, but I think now is the point where people, as I was saying before, can very rightly start asking, does the market deserve to be up here? Has it earned being up here? We've just been through US reporting season. Okay, so there was some return to growth. We've just been through the US reporting, the Australian reporting season. what you would characterise as, I would say, as a good reporting season. There were some healthy numbers come through. China's not a worry. That's not to say it won't be in the future, but there's not a lot on the horizon that would derail the current rally, I don't think, but it is starting to get to that, lofty valuation level where, as I keep coming back to, people will rightly start asking some questions about whether or not we should actually be trading up at these levels.
All right, now we talk about the levels in the US. What about for the ASX 200, given the moves that we are seeing in the US and also a pretty solid reporting season? Your call, which we've discussed at length with you previously, your call for 6,000 by the end of the year, I mean, it certainly looks like it might be coming to fruition.
Not by the end of the year, Leanne. You'll forgive me for correcting you, but by the end of the March quarter.
Okay,
so
apologies.
Not far away.
Yep.
No need to apologise at all. The only reason why I wanted to make that point is because I remember being on the show and talking to you about this target probably 5 or 6 weeks ago now, and there was a segment that followed and you had two other guests on the panel and they very quickly and swiftly said no, 6,000 is not achievable in the near term. I think we still can get there, and it has been, my prediction has been based on the fact that we would get through reporting season. It wouldn't be a bad reporting season. Okay, we've checked that box. And that US markets would continue to surge higher. We've checked that box. The only thing that hasn't followed through yet is the Aussie market. Now, I think it still will. I think there's still enough time between now and the end of the current quarter for the market to hit 6,000. And very interestingly, some people on the show this morning, I think it was Julia Lee, she is maybe starting to agree with me as well. She said something similar that, 6,000 is within reach and is looking more and more like a realistic possibility, if not probability. So there's been a little bit of vindication for me in the fact that a lot of the things that I said would happen have happened, but still a little bit of frustration because we haven't seen the Aussie market follow through to the upside. I think we still will, though.
Yeah, still many uncertainties, I guess. 57.71, 6,000 by the end of the March quarter, to correct myself there. Again, apologies, Chris. But let's move on. Let's talk about South 32 because we've seen a huge pop in those shares today, 9.6% higher currently, $2.73. We've seen some further broker upgrades. What's your view on the stock and whether you see further upside from here?
Well, this is a welcome relief for myself in particular, and we've held South 32 for some time now. It had what I thought were, at a headline level, and again, you and I discussed them on the show, some pretty good results. There were a few things in the results that were less impressive, but basically since the results, had a pop on the day and then it's been sold off pretty drastically. So a welcome relief today, the stock popping close to 10%. On the back of an upgrade, I think, from HSBC and being put on the conviction buy list at Goldman's. That's always nice. It's a ringing endorsement. But the other thing that has happened today is there's been a directive from the Chinese government. It actually happened some time ago, but we've only just learnt about it today. A directive from the Chinese government to 28 cities in China, I think including Beijing, to cut back on aluminium production and steel production due to smog levels, due to pollution levels. So, of course, aluminium is one of the commodities that South 32 is involved in. The net result by curbing production in these 28 cities, the numbers have been done, I didn't do these were done by Reuters, is suggesting that there'll be a 17% annual drop in aluminium production out of China. Now, obviously, that's going to be very supportive of prices. The aluminium market has been a particularly difficult market over an extended period of time now, so I think that's feeding into it today. And the further evidence of that is that alumina is one of the other stocks today that's up circa 9 or 10%. So nice to get those broker upgrades indeed, but I think there's a bit in the aluminium story as well, and those curbs in those Chinese cities on aluminium production due to pollution.
All right, fantastic. Yeah, thanks for taking us through that. We've seemed to be focusing on those broker upgrades there, but yeah, that optimism, I guess, flowing through to a lot of those other stocks, a lot of the other miners there as well. Just a quick final thought from you. I mean, we're sort of seeing mostly green across green there today. Where would you be looking right now for opportunities? What sectors are looking interesting to you?
I had a very robust discussion this morning, Leanne, with one of my fellow analysts about banks and whether or not the expectation for perhaps swifter, a greater number of interest rate rises in the US, whether or not it would be beneficial to Australian banks. The premise of my argument was that in the banks coming out and saying that they're putting up rates due to higher funding costs, which invariably they will do sooner or later, that they might add a bit of extra margin in there for themselves, thereby, expanding their net interest margins. My fellow analyst, my colleague, was of the opinion that given the political environment, they wouldn't do that. They wouldn't be so cheeky as to try and carve out a little bit more of the pie for themselves. Another analyst on the show this morning was talking about the fact that rising interest rates in the US will attract money into financials in the US and a lot of other financials around the world, and they will all sort of rise in unison off a lower base. So, look, the jury's still out. Obviously, I need to go and have a bit more of a conversation with my colleague, but banks are looking interesting to me again, both from a technical perspective and because of that shift, really shift in the expectations for not only the March interest rate decision, but the pace of interest rate rises in the US over the coming 12 months. I think before last night, it might have been that most people were looking at 2 at most. Now I think the conversation is firmly back to 3 for the remainder of the year, which is what the Fed had been talking about all along. So banks are looking interesting to me. I really still like the commodities story. Again, Trump rebuilding America, spending, what does he say, $1 trillion, some of it funded by the government, funded privately. $1 trillion is a lot of money. It builds a lot of bridges, and a lot of commodities need to be purchased to fuel that rebuild. So I still like the commodities story. So it's really those 2 pockets that are most appealing to me at this point in time.
All right, fantastic. Chris, as always, it's been great talking to you. Really appreciate your analysis, and we'll look forward to talking again next week. Thank you.
Thanks, Leanne.
Chris Conway joining us there live from the Australian Stock Report.